This short clip is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, and direct access to LaDuc Trading founder, Samantha LaDuc. For more information about Edge, visit www.laductrading.com/edge.
What's your kind of view of year-end performance given the macro headwinds? Now, right now, we don't have the flow, if you will, the CTA buying the positive gamma to really provide this tailwind for equities, and earnings are disappointing overall. And today and this week we have like 32% of the S&P report, so we'll get a much bigger picture. But long story short, we have the macro triggers right now that are helping the market to soften. What's your kind of end of year scenario for
Yeah, I am and I've been saying I've been looking for the second half of October into early November as, you know, a significant window of weakness being open where macro really can overwhelm. And if earnings didn't come through, which the jury's still out, right? We're still not, you know, we're still in the early part of earnings season, but so far it's been a struggle. And, you know, today with Google and, you know, look, Microsoft was up, Google was down, Texas Instruments was down, Meta's flat after the close. That's important. You know, Amazon and Apple's next week. But even some of the industrial earnings have been, you know, airline earnings were terrible. You know, so it's not, these aren't the type of earnings that are like blowing people away and saying, I need to be in stocks for the year end earnings reacceleration.
No, they're actually really bad.
Right. So, I mean, this hasn't been a reason to.
And the bar was low. So DataTrek actually came out on the 23rd and said Q3 U.S. earnings season has started poorly with fewer than average companies beating estimates. Analysts are taking Q3, Q4 numbers down as a result this week when 32% of the S&P reports, you know, they need to do better. And so far, not so far. They're not doing. But even before that, I have to show this particular, hopefully I can show this a little bit. Hold on, fit to screen. There we go. Hold that thought. I love this chart. Nope, that's not it. Share screen. There we go. All right. So this is interesting. Where are we at? Speaking of earnings, lots of expectations of beating because the bar was so low relative to last year. But stocks under the surface have been selling off quite aggressively. And I grabbed this. This is the percent of stocks in their respective sectors that are already in a bear market. So 68% of real estate stocks are already in a bear market. The only one that's kind of hanging in there is energy. And that has been a nice kind of softening underneath. We talked about this. This was on your sector rotation as way extended, right? And so usually we get a little bit of rotation, but they're not going into tech other than the mega cap. You know, magnificent. It was 8, then it's 7. It might be 6 or 5 now. But anyway, this is, I just thought, very compelling to kind of demonstrate what I have been seeing since that massive treasury issuance on July 31st that you spotted often and we're waiting for, and we have just rolled over solidly, maybe not so much in the top line, you know, SPY and NASDAQ, but underneath it has been deplorable breadth destruction. I mean, serious, like COVID, serious breadth destruction. And that's something that I track in the live trading room. And you know, because we saw it, it just never, ever stopped going down. Even when everyone during COVID was like, buy the dip, buy the dip. I'm like, no, the net selling is still there. The breadth destruction is still strong. And then when I saw this on Twitter, I'm like, that represents exactly, you know, by sector, how poor the market has been. Anyway, just had to point that out. So I'm definitely not a bull.
Yeah, look, I mean, I think, you know, if we're trying to nail the timing, you know, the way I'm kind of thinking about it is the next 1 to 2 weeks here is a very ominous time where macro overwhelms flows. The early part of earnings season has not been good. We have rising geopolitical concerns, and we don't have, because of where we are in the month, you know, we don't have the kind of structural flows, the buyback flows that would happen around options expiry and the likes. Now we are, as we transition through this week, we will reintroduce buybacks, which is you know, supportive for year end, and there are, you know, a lot of year-end dynamics in play in a year where the NASDAQ has done as well as it has. There's a lot of, you know, folks who have structured products that, you know, that came online the fourth quarter of last year that are well in the money. And there's some buyback flows, you know, and there's less days of trading in November and December. And so there's this natural idea of a year-end rally. potential as we, come into, and certainly as we come into the November and then for sure the December expiry, which are big structured product expiry windows, as we talked about. So that would be the bias. Would that be we could have some benefit into year end after this sell off that I would expect in the next 1 to 2 weeks. However, we're doing a lot of structural damage now to the tape. S&P is below the 200-day, 50 is under the 100-day. We're starting to chop off more and more names. The chart you just showed about the breadth deterioration. So look,
these are the ones that matter to me. I mean, all of that is because we have such an incredibly strong macro risk backdrop of dollar and yields. I mean, this is the dollar on a weekly. The longer it stays above this kind of 105, 106 area, the more bullish it gets. This is on a daily. That's a headwind. Bonds obviously are continuing to just fall out of a 40-year long trend line. I mean, perfect technical rollover despite that central bank coordinated intervention here in September, October. It's deplorable weakness. So, long story short, we also have, oh my God, hold on, currencies. Where are we? Where's the yen? There we go. All right. So what the heck? This is the dollar yen on a weekly that you just mentioned because it's alarming, right? We know it's compressed here at this 150 and Bank of Japan says, hey, you may not, continue. Well, over here on the other side, you got the JGBs and they are just like very strong, if 80, then 100 type of strong. So those are some major macro headwinds in addition to everything you've just talked about.
No, look, I mean, the macro setup would suggest, continued pain for risk assets, likely through year end. That's how I would describe it, unless we get some dollar liquidity release, which I don't anticipate we're going to get unless something breaks. And so far, since nothing has broken, we're not going to get that. So the macro suggests bad. But I think what we need to keep in mind, and I've been fooled by this plenty of times this year, is that time winds up not being a bear's friend. And by that, I mean, normally we think of, gravity is, kind of pulling markets down or pulling things down. But in this case, the gravity that is associated with time and the VIX and volatility makes, levitates markets, right? If we don't get a continuation of selling and of move, like the VIX is 20, if we don't get moves north of 1% or 1.5% in a day, then there will be vol selling. And as there is vol selling, it levitates the S&P and it levitates the big cap names, which are the biggest components of the S&P. So there is this structured product, structured volatility dynamic in play that at certain times, and I know it sounds crazy, but we've seen it time and time again, it offsets the macro headwinds, right? I mean, so there are windows where the flows just matter more than the macro. And as you think about it, into next week, right, volatility is going to be very, very elevated into the Fed meeting, into the BOJ meeting, which is Monday. The Fed is Wednesday. The QRA from Treasury is Wednesday, and then payrolls are Friday, right? We have a very elevated vol window next week. As we pass through that, unless the market is moving 1 to 2% a day, realized volatility is going to fall, and then vol sellers are going to come in, and then we're going to get into November expiry, and that's going to be your potential window to bounce. So we just need to keep those timing windows in mind when we're looking at it. So that is the most bullish thing for year end is that time and lack of trading days, structured product volatility around expiry windows, and the fact that the Magnificent Seven stocks are up on the year typically creates that dynamic of year end window dressing. Other than that, we should be and likely will move materially lower.
Watch the full episode and subscribe to LaDuc Trading YouTube channel for more macro to micro videos and other content.